Overall, my company shows mixed financial results in 2025. The company's liquidity position improved significantly, with positive working capital and a stronger current ratio. This means the business is more capable of meeting short-term obligations and maintaining operational stability. But profitability has weakened substantially. Despite strong revenue growth and stable gross margins, net profit and return on equity both declined sharply. This suggests operating expenses increased faster than revenue growth. The company also became more leveraged, with debt slightly exceeding shareholder equity in 2025. While this is not necessarily critical, it does increase financial risk if profitability continues to decline. But overall, my company appears to be financially stable in the short term, but less efficient at generating profit and shareholder returns compared to the previous year. Scenario 1 examines the impact of launching a new product line that generates an additional $983,000 in sales revenue. In this scenario, revenue increases to approximately $4.26 million and gross profit rises to approximately $2.77 million. Net profit after tax increases significantly from $69,000 to approximately $516,000. For simplicity, this scenario assumes fixed operating expenses remain unchanged in the short term. And this scenario greatly improves the company's profitability, working capital, liquidity, and return on equity. It would also provide greater capacity for reinvestment and future growth. However, operational impacts would include increased production demand, greater pressure on staffing and logistics, and the possible need for larger premises or inventory management systems. Suppliers would also likely experience increased order volumes, while customers may benefit from improved product variability, variety, and availability. To maximize the benefits in this scenario, several strategic recommendations are proposed. Firstly, my company should scale operations carefully to ensure staffing, inventory, and supply chains can support high demand without creating operational inefficiencies. Secondly, management should strengthen working capital management by closely monitoring receivables and inventory levels to maintain a healthy cash flow. Thirdly, the company should invest in operational efficiency improvements, including automation and streamlined production processes to maintain strong profit margins. And finally, the increase in profits should be strategically reinvested into growth initiatives, debt reduction, and cash reserves to improve long-term financial sustainability. Scenario 2 examines the impact of a 10% increase in wages and salaries due to award changes. This increases the outgoing expenses for wages and salaries from $1.12 million to $1.24 million, and as a result, the business moves from a profitable position into a small loss of approximately $12,700. This scenario does not increase revenue, meaning that higher operating costs directly reduce profitability and cash flow. This scenario demonstrates the company is highly sensitive to increases in operating expenses, and reduced profitability would weaken retained earnings, reduce return on equity, and potentially place pressure on liquidity over time. Non-financial impacts will also occur that could include improved staff morale and retention, but the business would also face pressure to increase prices or improve productivity to offset higher wage costs. There's several strategies that could help my company respond to raising wage costs, which includes a need to focus on improving labor productivity by streamlining workflows and reducing inefficiencies. Secondly, management should review pricing strategies to determine whether a modest price increase could offset some of the increased labor costs while the company remains competitive. Thirdly, the business should implement broader cost management strategies by reducing discretionary expenses and prioritizing essential operational spending. And finally, workforce planning should be reviewed to ensure staffing levels and rostering arrangements remain financially sustainable. Here we compare my company with JB Hi-Fi using key financial ratios. My company performed strongly in gross profit margin, liquidity, and working capital, and its gross profit ratio of 65% was significantly higher than JB Hi-Fi's 22%, which indicates stronger margins on products sold. The company also had a stronger current ratio, meaning better short-term liquidity and ability to meet current liabilities. However, JB Hi-Fi outperformed my company in profitability, efficiency, and shareholder returns. JB Hi-Fi's net profit ratio and return on equity were both substantially higher, showing stronger operational efficiency and better use of shareholder capital. My company also had slower debtor collection, taking approximately 25 days to collect receivables compared to JB Hi-Fi's 9 days. So overall, my company appears more liquid, but less efficient at converting revenue into profit compared to JB Hi-Fi's high volume retail model. My company demonstrated several strengths, particularly in gross profit margin, liquidity, and working capital. The business maintains strong margins on its products and has a stronger short-term financial position with sufficient current assets available to meet liabilities. However, JB Hi-Fi performs significantly better in profitability and operational efficiency. Its higher net profit margin and stronger return on equity indicate more effective use of revenue and shareholder capital. JB Hi-Fi also collected receivables much faster, improving cash flow and reducing time taken to convert sales into cash. So overall, my company appears financially stable in the short term, while JB Hi-Fi demonstrates stronger profitability and operational efficiency. This suggests that my company should focus on improving cost management and efficiency to strengthen long-term financial performance and competitiveness. Overall, my company demonstrated improved liquidity and stronger short-term financial stability in 2025, particularly through higher working capital and an improved current ratio. However, the business also experienced declining profitability and lower shareholder returns, indicating reduced operational efficiency despite revenue growth. The scenario analysis showed that revenue expansion through a new product line could significantly improve profitability and strengthen the company's financial position. But in contrast, increases in operating costs such as wages could quickly reduce profitability and place pressure on cash flow. The comparison with JB Hi-Fi highlighted that while my company performs well in liquidity and gross profit margin, it still needs to improve efficiency, profitability, and returns to shareholders to compete more effectively in the industry. Overall, the findings of this report highlight the importance of balancing profitability, liquidity, and operational efficiency to ensure long-term financial stability of my company, Proprietary Limited. Thank you. And here's a list of the key references used in preparing this report.